Good afternoon, everybody, and happy Friday, and welcome to this post-budget webinar. As we do every year, we are one of the first business associations to bring you useful insights given and provided by experts in their fields. We always have an economist from a local bank and an economist from a foreign bank, and we always round up with a tax expert. And we are going to do exactly that today for you. We've got a tremendous lineup of speakers. We've got Irvin from DBS. We've got Valerie, Teck, Leng, and Ching from UBS. And Tay Lek is our tax expert from PwC. In a short while, I'll invite Irvin to commence his presentation. Each speaker has 20 minutes. And the three professionals from UBS have got to share that 20-minute slot so that we all have enough time for a Q&A. And I'll be back to have a couple of questions with the panel before answering your questions. So please feel free at any time during the presentations to type in your questions in the Q&A function, which you'll find in the toolbar at the bottom of your screens. Unlike many other institutions, we're very democratic, so it means that you'll be able to see everybody's questions, including your own, and you can upvote those questions that you think I, as the moderator, should be posing to the panel. So without further ado, I'm going to hand you over to Irvin. He will be followed in the order on the screen by Valerie, Teck, Leng, Ching, and finally, Tay Lek. Irvin, over to you.
Thank you, Victor, and it's really very good to see you again. I mean, I remember the last time we met us probably a few years back, and last year has been exceptionally challenging for all of us. Now, before I begin, this is still Chinese Lunar New Year. We'd like to wish all of you a happy and auspicious New Year ahead. Okay, I initially have prepared a lot of slides, but I'm going to zoom in straight into the key focus, which is budget 2021. And unlike what I usually do, I will leave the discussion about the Singapore economic outlook to our friends from UBS. So let me just share screen with all of you. Okay, can you guys see my screen?
Yes, we can. Thanks, Irvin.
Okay. Now, budget 2021, this is a very interesting budget in my opinion. Last year, we saw the rollout of 5 separate budgets, and this is totally unprecedented. I mean, in all my years as an economist covering Singapore, we have never need to write 5 separate budget analysis paper, and last year was really taxing. And I know on the ground for businesses, it has been an exceptionally challenging year as well. So why is budget 2021 different from what we have seen last year? Now, here are some slides I'm going to share with you on my take on this budget. Before I move on to a key focus of my presentation, which is what are some of the key macro trends that businesses should be prepared and should anticipate in a post-COVID world. Well, first and foremost, 11 billion deficit. This is very much in line with our expectation. Before the budget, we were looking at 10 to 12 billion, so 2.2% of nominal GDP. Now, this is a sizable fiscal allocations. Why do I say so? Well, you can't compare to last year. Last year was really an exceptional year. I mean, we are in crisis mode. So therefore, it is important the government roll out substantial fiscal response to buffer the impact of the COVID crisis. But at 11 billion, it is still very sizable, because if you look at the chart here, it shows you the overall fiscal balance for the Singapore government prior to 2020, and on average every year the government is able to accrue about 3.1 billion surplus. So at 11 billion, that is about 3.5 times that average. So it is still a fairly sizable budget. Also, what is interesting about this budget is that it is funded entirely by reserve. So last year, the government tapped on drawdown on the reserve 52 billion. The government didn't use all of them, and there is still a leftover of 9.3 billion unutilized. And henceforth, of course, it makes sense, to use this amount, and then of course, with an additional drawdown 1.7 billion. Now, doing so basically reflects a cautious stance by the government. I think the government is taking, fairly conservative approach with regards to medium-term outlook, and henceforth they have decided to keep their fiscal powder dry in case fiscal economic conditions deteriorate further. More importantly, there has been a marked shift in terms of the fiscal stance or the flavor of the budget. Last year, because it's crisis mode, most of the policy measures are very broad-based. And it is important to rush out all these broad-based support measures to help companies. But this year, as the economy moves towards a recovery phase, it is important to allocate resources to only those industry or companies that require help. For example, the JSS for aviation and tourism sector has been extended because these two sectors are the worst hit by the pandemic. Another feature is that last year was really about counter-cyclical. As I mentioned, it is to buffer the impact of COVID on the economy. But this year, the focus is really about transformational, essentially to spur economic transformations in Singapore. Now, the chart here basically shows you that some companies, some industry actually took longer than expected, will take longer than expected to recover. So it is important that we continue to give them the necessary support. And for those industry that are doing better, now is the time to focus on the medium term to help them emerge from this crisis even stronger. So one of the key feature is this 24 billion allocations over the next 3 years on economic transformations. This include the enhancement and extension to some of the schemes like the Productivity Solution Grant, Market Readiness Assistance, and also the Enterprise Development Grant. So this will replace some of those short-term measures that we have seen last year. Another key shift in terms of focus, the budget continued to, focus on, addressing the labor market weakness and also to strengthen the social compact. However, what is really different is that instead of saving jobs, the focus now is about creating new jobs. If you look at a chart here on the left-hand side, that shows you the current conditions in the labor market. It has already bottomed, but our view, and in fact, this is also based on my conversations with the manpower minister, is that the government also feel that, in the first half of this year, labor market will continue to remain weak, and we will only see a more pronounced recovery in the second half of the year. But much really depends on the economic conditions in the months ahead. So therefore, it is important to create jobs to absorb the current slack in the labor market. Today, there is still roughly about 100,000 residents that are unemployed. So it is important that the government extend measures such as the SG United Jobs and Skill Package, which totaled 5.4 billion. Another area of focus is, as I mentioned, to strengthen the social compact. Now, what we have seen throughout the COVID crisis is that this is a highly regressive event. It affects the lower income much more than the mid to high income. In DBS, we conducted a study last year. Basically, we look at the accounts of 1.2 million of our customers, and we found that out of 1.2 million customers, 26% of them have experienced more than 10% decline in income. And among those that experience income deteriorations, about half are those earning below 3,000. So it is important to roll out the appropriate policy measures to help the needy families and households. Now, another feature of this budget is the notion of fiscal sustainability. It has remained a key focus for policymakers. I wrote about this, over the years, particularly in 2017, March, I remember. I wrote about a paper about fiscal sustainability, and a lot of people ask me, why do you even bother to write about fiscal sustainability in Singapore? The Singapore government runs huge fiscal surplus every year. And then I went further in November 2017. I predicted that the government will introduce GST, and true enough, the following year, during the budget announcement in 2018, the finance minister announced, that they will hike GST, and of course, this year, by right, we should be, witnessing a hike in GST, but it was delayed because of the COVID crisis. Now, why is there a need to fund recurring expenditure with recurring revenues. Now, if you look at the chart here, it shows you the the primary balance of Singapore. Now, primary balance is essentially just operating revenues minus away total expenditure. Now, in business terms, it is almost like a gross profit, right? So now in Singapore, what is really unique is that we have a big source of revenue, and that is the NIRC. Without that, we essentially is dependent on the primary balance. So to know whether the fiscal position is sustainable in the long term, we have to look at the primary balance. And in 2015, what I saw was that Singapore somehow is showing some signs of stress in terms of maintaining a primary balance, a primary surplus. So which is why I expect that the government will introduce a hike in GST sometime down the road. And true enough, we will likely expect a hike in GST somewhere around the second half of 2022. If not later, first half of 2023. Much really depends on economic conditions. Another key point of discussion is about funding infrastructure projects by borrowing. Now, some people think that this is new to Singapore, but in actual fact, it is not new. When Singapore built its first MRT line, it builds Changi Airport and develops Changi Airport further. It builds many of the infrastructure pertaining to utilities under PUB and also housing under HDB. A lot of those projects in the past, in the 1990s, 80s, and 90s, are actually funded by borrowing. So it is not new to Singapore. Also, now given the low interest rate environment, it is more efficient. It's a more efficient way of funding. Another key argument is that borrowing for such infrastructure project with long shelf life, it ensures intergeneration equity, whereby the benefits is shared across different generations. Henceforth, it is also important that the liability is shared across different generations as well. One of the another key feature of this budget is all about going green, about sustainability. Some of the enablers I've listed out here, and also some of the drawbacks, which includes hikes in the petrol duties, carbon tax will be raised. But again, it didn't come out of the blue moon. The government has already hiked the diesel excise duty in 2019, and also the water tariff back in 17 and 18. Now this is all in line with the much broader blueprint of Singapore Green Plan 2030. Another area which also was highlighted is the issuance of green bonds to fund environmental related projects. Well, it's not, the government can fund infrastructure projects through other ways, but the thing is that why green bond, particularly for environmental related projects? And I think the main reason is to support MAS, a drive to make Singapore the green financing hub for the region. And to date, there are already 19 billion worth of projects identified that they will issue the green bond on. Okay, I've touched on some of the key focus of budget 2021. Let me move on to some slides which I want to share with all of you that I think all businesses should be aware of, in the as we move into a post-COVID world. What are some of the macro forces that could potentially shape the dynamics in the region and also your business? Here are some of the issues that I'm going to touch on. First and foremost, risk of high leverage and policy unwinding. I'll elaborate further on this. And also, just now I briefly mentioned about, COVID-19 is a highly regressive event, and we need to do something about that. And then, on the third point, a lot of people have spoke to me and say that, we are heading into a bifurcated world. But in my mind, I think it is not just about, bifurcations. I think we are essentially moving into a new global order, and such phenomenon has actually been happening over the past 10, 15 years. I'll elaborate more on this. Finally, diversification and regionalization. This is trend that we have witnessed happening more rapidly in the region in the past few years. And I think it does suggest significant implications as well as opportunities for businesses. Now, high debt ratio. Well, the chart here shows you what happened to banks' balance sheet. Especially here, we look at the loans to GDP ratio. Immediately after the US financial crisis and the European debt crisis, there has been deleveraging, a lot of deleveraging. So loans to GDP ratio actually has turned negative, it has been falling. But what is different in COVID-19 is that because of the ultra low interest rate environment, you see the leverages rising. It may not be a problem for now, but I think we need to watch this space very carefully. It could potentially become a concern going forward. Another area that we should watch out for is that for some countries that are not able to continue with their robust fiscal support. I mean, last year we have seen countries all around the world basically put out very strong fiscal response to the crisis. But this year, I think some countries may not be able to do so. I mean, Singapore has the luxury of falling back on its reserve, but that's not the case for many countries out there. Many of their fiscal budgets have been funded by debt, by borrowing. And I think that is not sustainable. So this year, there will be a sharp pullback in terms of fiscal support, and that could potentially affect the growth outlook for some of the countries. Now, I've already talked about, that COVID-19 is a regressive, event. It makes the poor poorer, and perhaps, given the low interest rate environment, it may potentially make the rich richer. So the outcome is that we could potentially see a widening of the income gap. Basically, that was the conclusion in the report that we issued last year, and we had, following up that the publication of that report, we had a series of meeting and communications with the government agencies to discuss about this. And I'm happy to say that the government has rolled out a very comprehensive plan to elevate that concern. The Gini coefficient that has announced recently remains fairly stable, but that may not necessarily be the case for many countries around the world. Also, we need to be mindful that there has been an inequitable distribution of vaccines. The chart here shows you the progress of vaccinations across the key regions around the world, and you can see that the developed economies is definitely, they are definitely doing much better when it comes to vaccinations, and the developing countries are actually quite slow. So remember this. This is a crisis whereby we will not be able to get out of this unless everyone is out this together. So, for example, even if you are able to vaccinate the populations in the developed countries, but look, remember, if you start to open up the borders, there will be global travel, and also the virus is mutating. So, at some point in time, if you don't vaccinate the entire population, or at least a sizable portion, COVID could actually come and hit us, sometime down the road again. Now, I want to talk about, are we heading into a bifurcated world, or are we heading into, or is this just simply a new global order? Now, this chart here shows you the trade linkages of the various countries around the world with the US and China. If the particular country trade more with US, it will be blue, and vice versa. If they trade more with China, they will be red. Now, why 2021? Because this is the year when China joins the WTO. So back then, the global map was literally almost blue. Fast forward to 2018, when trade war first started, basically it is almost red. All right. I think this is the main reason why the Trump administration is exceptionally uncomfortable, which is why they started the trade war. Now, I want to basically just run through with some of you regarding the history of what happened earlier on, and what brought us here to this point in time, right? So that we have a better understanding of the context. So Trump started the trade war, and in 2018, and one of the key focus is to narrow the trade deficit with China. Back in 2018, the trade deficit was roughly about 425 billion. Did Trump do a great job and achieve his objective? Well, not quite, because yes, indeed, the deficit is narrow, but it is still fairly high at 315 billion as of 2020. And also, what is the outcome when US try to reduce the trade deficit? Basically, it implies more trade diversion towards ASEAN. So the deficit with China may have shrunk a little bit, but US trade deficit with many of the regional peers have actually increased. All right. Also, what about Trump's talk about bringing investments and jobs back to the US? Well, this is a chart on US outward direct investments over the years to ASEAN, Asia 10 economies. In 2018, when trade war first started, there was a reversal. So the outward direct investment actually turned negative. But it didn't last long. By 2019, US company has started investing even more into Asia 10 economies. So what I'm trying to say is this. what we are witnessing is a global phenomenon. I mean, the center of gravity is shifting more towards Asia. And in fact, even the most powerful man in the world can't stop that. This is basically global economic forces at work. So I think the new US administration understand that. And on that account, I do expect a more certain US and China relationship going forward. I'm not saying that the US is going to be nice and friendly with China. I think US will continue to maintain a very tough stance towards China. But in area where there is room, common interest, I do foresee room for collaborations. For example, the US has already signaled a return to the WTO, and that will strengthen the rules-based global trading system. And that definitely will bode well for a small open economy such as Singapore. On climate change, I think there's a lot in common between these two countries. And of course, in the immediate term, there should be room for collaboration to counter the COVID virus. Then this brings me to the next issue. Now we talk about US and China, and I think the need for them to coexist together. I see a hands up by Victor. Okay, I will try to speed up. Okay, well, who is driving global growth? But to answer these questions, perhaps we should ask the question, what is global growth? Global growth at the end of the day is the summations of the growth of every country around the world. Now, to know which country is really driving global growth, we look at the change in the nominal GDP of that country in absolute dollar value. Now, US has been #1 for many years, but things changed after 2010. In the 10 year from 2010 to 2019, China has actually outpaced the US in these regards. So if China is actually growing more, China is also adding more to the global table in terms of growth. So who is really driving global growth? I think what we are seeing in this chart is that China actually has been doing a fair bit of the heavyweight lifting during that period. And US is actually not that big after all, because at the end of the day, if you sum up the nominal GDP of the Asia 10 economies, they are already bigger than the US economy. So no doubt the US on its own is still large, but I think increasingly Asia is matching up to that. And this also explains why trade flow is going more and more towards Asia. Now today, about 30% of all trade flow goes through Asia. In Asia, there is a bright spot, and that is ASEAN. FDI flows has been, rising. FDI flows to ASEAN has been rising and has already surpassed that to China. And I think these trends will continue. You'll start to continue to see this kind of divergence. Now, why is ASEAN such an interesting market for global investors? First and foremost, it is a big market. Today, it is the 5th largest, and by 2030, it's going to be 4th. It has also a very big population. 670 million. This is twice the size of the US economy. Also, the population, if you look at the chart here, is a very young population. Apart from Singapore and Thailand, most of the country has very young populations. And there is also rising stars such as Vietnam. I wrote a paper 2 years ago, essentially predicting that by 2029, Vietnam will be bigger than the Singapore economy. Now, that essentially implies tremendous opportunities for companies. Then what's in it for Singapore? We are a regional hub. And of course, air travel has been affected, but I think after COVID, we will be in a much better positions to tap on opportunities in the region. So I would encourage all companies to start looking at the regions and to enlarge your footprint in the region and capitalize on the opportunities ahead. Lastly, Singapore is also well placed to capitalize on that as well. If you look at the chart here, it shows you the relative competitiveness map for Singapore versus the ASEAN peers, and Singapore definitely is in the strong position. Now I've come to the end of my presentation. Thank you, and I shall hand it to the next speaker.
Thank you, Irvin. So from the UPS perspective, we want to give everyone a more multidimensional perspective coming from economics, currencies, and equities. So what really stood out for me on the budget are the following points. I think Irvin has already illustrated very clearly all the different measures. But for us, I think the first point is there's less fiscal spending than last year. We saw the 2.2% deficit versus the 13.9% before. With the supporting measures and in the environment of continued easy policy, this should keep Singapore's cyclical recovery on track. We continue to expect a vigorous recovery in nominal and real GDP for Singapore this year. We are estimating at about 7% on real GDP, which is more optimistic than the official estimates. And the sequential pace is going to be the strongest in the second quarter, which is in line with our expectations for a developed market recovery as activity lives through 2021. And also, second point, the more targeted approach in providing fiscal measures is appropriate in our view, given that some sectors have recovered strongly and external demands appears to improve further. So if we look ahead to the opportunities amid these tech advancements and the changes in the global supply chain, we think that Singapore will benefit as an export-oriented economy and its exposure in the tech sector. The third point is, it is reasonable to expect that the fiscal position is going to be tighter in the coming years, not exclusively just Singapore, because as countries exercise prudence, countries are going to exercise further prudence when the economic condition is starting to normalize. So Asia's growth is going to step up, and this means that there's going to be less stimulus that's needed. And previous stimulus measures will slowly be wound back to stabilize the fiscal indebtedness of each country, which was chalked up due to the pandemic. And also, fourthly, we think that the government's push for structural transformation in the coming years and its initiatives in ASEAN actually ties in with the broad CAPEX recovery theme that we are expecting. Several factors we think would drive the CAPEX boom includes the supply chain migration, the tech and digitization in China, North Asia, and Singapore, a resumption of construction infrastructure in emerging Asia. So net, there's going to be a resumption of investment growth in the coming years. And also, if you notice from the budget communication, there was significant emphasis on ASEAN in this year's budget, which I think is understandable given the vast opportunities in the world's fifth largest economy. I think Irvin has brought up some points there, but we think that with urbanization, economic growth is occurring not just in the ASEAN megacities, but also in some of its mid-sized cities. And also with the recent RCEP agreement, which resolves this noodle bowl problem of ASEAN of being entangled with multiple FTAs, will in fact attract significant investments from members within the FTA. And there is also strong interest we've observed in the supply chain relocation into ASEAN. So last year, I think we continue to see China investing in places like Malaysia, Thailand, Indonesia. So UBS estimates that there's going to be about $70 billion of CAPEX spending at FDI, which could go to ASEAN, India in the coming years as a result of it. So given Singapore's capabilities and close proximity to the ASEAN market, we expect it to serve as a key hub that enables countries outside of Southeast Asia to access the region. So at the bottom line of the budget, we think that there's still risk with regard to the pandemic on the vaccine front, potential resurgence of cases and new strains being reported. But as DPM Heng has also brought up during his speech, there's definitely still room for additional support measures, particularly for the laggard sectors via a supplementary budget if the economic outlook weakens or if the pandemic takes a turn for the worst. Yeah, so you move on to the next slide. The budget was penciled with a growth recovery backdrop in mind. So in 2020, we saw that ASEAN has lagged North Asia and China when it comes to the economic recovery. So the key difference this year will be the delayed arrival of the growth recovery at different stages. Singapore, being most plugged into the global export uplift, is expected to experience more advanced growth trajectory in the first half of the year. And we expect developed market recovery to be a key driver for this overall demand. So far, what we are seeing, demand from US and China have held up better than the other markets. Electronic exports stayed buoyant, which has helped keep this manufacturing sector in Singapore well supported. And from the production data, we are also observing that the recovery is underway, with Singapore being the leader. And also a turnaround is happening in terms of industrial output for the laggards compared to a couple of months ago. And then also in terms of the sequential growth, we also expect a speed bump, a second bump in growth sometime in the second half as the vaccine rollout drives economic reopening. So it will benefit the consumption economies such as Philippines and Thailand. So on the next slide, so part of the COVID-19 legacy is a reduced capacity in terms of the service sectors, but we believe that the general recovery of the Asian consumer has yet to play out. So ASEAN will be a bigger beneficiary of consumer service revival, with Singapore in the lead in terms of the retail sales uptrend. So I think lifting the temporary measures with the rollout of vaccines in the region will drive the consumption rebound, and households and firms will spend some of their pent-up savings, which will further drive the pricing of consumer service. So we do see several opportunities to position for this ASEAN rebound. First, ASEAN FX market is fertile for gains versus dollar, given the bloc is a prime beneficiary of catch-up story, solid balance of payment, and the vaccine bonus. And also in terms of consumer demand recovery in ASEAN, we do expect the significant consumption services revival. And also last but not least, there's going to be economic acceleration in Singapore, which will be a beneficiary of the reflation theme, where we see opportunities in banks and property. So if you would like to understand more of this, do feel free to speak to some of our UBS colleagues. So with the economic backdrop, then what then is our expectations for Sing dollar and interest rates? Over to you, Teck.
Thanks, Valerie. So taking the positive backdrop from Irvin and Valerie, I think the biggest thing to highlight is that this year is going to be a pretty strong year for Singapore, both in terms of economy, in terms of currencies, and of course, as well as the equity market. And I think for many of us who understands how the currency is managed in Singapore, you would realize that the MAS actually somewhat weakened the Sing dollar last year in the depth of the COVID-19 pandemic. And this year, we are looking forward to the MAS actually moving towards a slightly more positive policy tone. And we are looking for the Sing to strengthen to about 127 against the US dollar. How it is relevant for individuals? I think firstly, if you are an investor, especially if you do have exposure in US denominated assets or equities, you should actually pay attention to the potential weakening of the dollar. What it means for you is that you can consider, for example, taking a loan in US dollars instead of converting your Sing dollar into US dollars. So it helps you to manage the risk of the dollar weakening against your home currency. For businesses, I think it is more important to be thinking about whether you have revenue in US dollars that you would like to hedge, given our view for the dollar to weaken in the next 6 to 12 months. Now, very quickly touching on the interest rate environment, Singapore interest rates by and large tracks the US interest rates. And I think the reality is that we expect the US interest rates to be close to zero for the next 3 years at the minimum. So I think it is a great environment for borrowers, especially corporates looking to raise debt. It is a very friendly, low interest rate environment, but it penalizes the savers among us, because your interest rate is not going to compensate you for the inflation that you might be facing. So I think on this note, it is important to make your cash work harder. Obviously, low interest rate is a very good environment for asset prices. And I think over here, it would be important to think about what it means for the equity markets as well.
Indeed. Thank you, Teck, for mentioning that, because we are, in fact, positive on the Singapore equity market. To put things in a regional context, UBS has Singapore as one of its most preferred markets regionally in its equity strategy. We like Singapore for a couple of reasons. Firstly, valuations are undemanding. And secondly, we are seeing strong evidence of a recovery, not just in the economy, but also in terms of underlying earnings of corporates. So I would like to highlight today 3 areas where we think the budget this year could affect the Singapore equity market. Now, as an equity analyst, the most frequently asked question that I get is, what sectors are affected by the budget and who stands to benefit? In a nutshell, the slide you see in front of you summarizes some of the sectors that benefit at the margin. In a nutshell, I can summarize by saying that the sectors that have been hardest hit by the pandemic are those that will derive the most benefit from this budget. So these include aviation, aerospace, tourism, taxis, retail, even arts and culture. The next question that a lot of investors ask me is, so should I go and buy these sectors? And the short answer is, well, we do need investors to be quite discerning here, because firstly, in some instances, we have already seen share prices recover to pre-COVID levels in an environment where we think the earnings recovery will be very long drawn. And in other instances, we would also highlight that it's a very uneven recovery. The pace of recovery differs is quite varied among different sectors. So as an equity investor, one needs to be very discerning. The second thing I wanted to talk about today is the retail sector. And moving on to the next slide, we can see here that by and large, among the retail REITs in Singapore, most of them have already seen their tenant sales recover close to pre-COVID levels. You can see that the worst of the downturn was in the second quarter of last year. That coincided with the lockdown when malls were closed. Subsequently, as the economy reopened, we saw a V-shaped recovery in tenant sales. And as we progress on to phase 3 of our reopening, and with the vaccines being rolled out, we expect this momentum to continue. Budget 2021 gives a boost to the retail sector in 2 ways. Firstly, as our speakers mentioned earlier, we are gearing up for our goods and services tax to be raised as early as next year. So with that in mind, that could potentially prompt some front loading of consumption prior to a GST hike. And the second way that Budget 2021 benefits the retail scene in Singapore at the margin is via the imposition of GST on low value imports. What this does is that currently, if I were to, for example, do my shopping on e-commerce, products can be much cheaper versus a retail store. But once these imports get GST imposed, then the playing field gets leveled, and at the margin, that could fuel some demand to the local retail scene. So those are some ways at which, at the margin, we might see the retail scene in Singapore benefiting marginally. The third thing that I wanted to talk about is not what was announced during the budget, but rather what was not announced during the budget. Now, what I mean is this: leading into the budget 2021, market watchers were speculating that the minister could potentially have announced property cooling measures to cool the property market because, well, the market has defied gravity. So the fact that this was not announced is actually positive for property developers. We think it can remove some overhang on the sector where stock prices are already trading at steep discount to book values. In this chart, you can see here that last year, property prices rose by 2.2% overall in the private property market. Both landed and non-landed home prices rose last year. And in the next slide, we can see that even if we were to dissect this by location, by and large, prices were stable to higher across all regions in Singapore. The point I want to make is this: last year was the only year and the first time that property prices rose despite a recession. If you can refer to the chart in front of you right now, in the 1997 Asian financial crisis, as well as the 2008 global financial crisis, property prices fell across the board. And that's only natural, right? However, this time, due to ample liquidity, due to low interest rates, asset prices have held very strong. And that's one reason we think why our ministers have explicitly said that they are on the lookout and they are ready to step in if needed. In our view, the decision on whether or not to impose property cooling measures will be data dependent. If home prices, if the rise in home prices outpaces underlying economic fundamentals, that's where we would see risk of the government stepping in with some cooling measures. maybe I'll wrap up with my final slide here. This slide showcases the UBS Global Real Estate Bubble Index. What we do in UBS is that every year our global analysts come together and try to compare prices of homes across various financial cities relative to their fundamentals. And in this regard, Singapore ranks as fair valued relative to global cities. I think this is a combination of various factors, and it's also testament to the success that our government has had in trying to contain asset bubbles even before they form. So if you would like to know more about this report, or if you would like to hear more about what our colleagues have said, please feel free to reach out to us or to any of our UBS client advisors who are in this call. And with that, I will hand it over to our next speaker. Thank you.
Hi. Okay, can you see the screen?
Yes, thanks. We can, Tay Lek.
Okay, thank you. Hi, good afternoon, everyone. Gong xi fa cai. Okay, for now, after what the UBS team has done, I'll take you guys through the tax-specific measures of the budget. Just a bit of maybe kind of a recap of what's been going on for the past few budgets. Tax, as you all know, right, is the one measure that the government has to bring in revenue so they can fund its spending. And tax changes, tax measures used to be top of the in the main text of the budget speech. But in recent years, it's been relegated to an annex, and this year is no different, right? The program is I think this reflects the government's the fiscal position that we have, that we are moving from tax, and then we are bringing in the NARC contributions to fund the overall budget. And this as Irvin shared just now, right, is something that no other government perhaps have compared to Singapore's. So just quickly running through here. Okay, so the first part of the budget on tax is really to support the recovery. So what they have done is to continue allowing companies and businesses to claim accelerated capital allowance. So if you make an investment, you can claim your 75% of your costs on investment in 1 year, and then the remaining 25% the next year. So I have an example, a numerical example here, where you can show the effect of it. On the second column, you will see that this is the normal tax rules. If you bought a $6 million piece of investment, you get write-off over 3 years, 2 million every year. Okay. But for last year and also for this year, if you buy qualifying equipment, you get a 75%, which is 4.5 million, and then a 25%, which works out to be 1.5 million. So in terms of the tax savings or tax impact that you have, you see that the differential between the two treatment or two options, right? You get to save cash of 425,000. But for the next 2 years, you kind of pay back that saving. Okay, so this is a way for them to be, to let businesses and companies conserve their cash flow, with their investments, and to encourage businesses to continue making investments even in this pandemic. The next measure is also to allow a 1 year write-off, a faster claim for renovation and refurbishment expenses, right? So for the first 300,000 of expenses, you get to write it off within a year, rather than instead of over 3 years. So in that sense, you also get your cash flow savings in terms of lesser tax paid. But just to remind everyone that this measure was also there last year. So between this year and last year, the maximum you can claim is still subject to the 300,000 cap. And carryback relief in this, for this measure, the idea is if you have excess losses or excess capital allowance, you can bring it back to offset any tax payable for 3 years of assessment immediately preceding this year, 2021. Okay. The idea is if you have lost this year, but then you paid taxes maybe last year, you can get back some of those tax as a refund. If you just look at the quantum, is capped at 100,000. Obviously, it's targeted for the benefit of the small and medium enterprises. I think the budget is also, as you can see from the theme of the minister's speech, right? He has to us, there are 3 focuses, okay? One is supporting that recovery, and then the next one is really to assist businesses, companies transform the way they work, to transform the way they enter into new markets. Oops. Sorry, I'm sorry, I think there's something wrong with the slide. Sharon, are you able to pull up your copy? Okay, sorry. I think I've got it. Sorry about this.
Oh, okay, sure.
Yeah, I don't know what happened just now. Can you see it's measures for innovation internationalization?
Yes, we can.
Yes.
Thank you.
Sorry, apologies, everyone. Okay, so I was saying in the budget, there was also tax measures to encourage, transforming businesses to transform the way they work. In this case, the government will give investment allowance for acquisition of automation equipment, right? They have extended the scheme for another 2 years, and for other aspects of this automation support package, right? Like if you get a grant funding plus also government co-sharing of financing, you can go to ESG and apply for those under the other schemes. I think this next measure is an interesting one. Basically, what they are trying to do here is to give a double deduction. So if you spend $100, you get $200 of deduction for internationalization. So it is really to encourage Singapore businesses to go overseas to look for new markets. In the past, it used to be that you must travel. You must go and participate in an overseas trade fair. You must go and meet your customers in that foreign location. Of course, with the travel restrictions because of the pandemic, none of this is happening. So what the government has come up with is really to allow this to give a recognition that this kind of marketing and sales activities must still continue, and people are doing it virtually. So the government is going to allow deduction claims, for if you are participating in virtual trade fairs, right? So you get your deductions for your package fees, any third-party costs to design, digital collaterals, right? And also you get your logistics costs to send your materials and samples to clients whom you've met at the fairs, right? And also going forward, you also get deduction, double deduction for your approved product service certification, and also just undertaking overseas advertising promotional campaign. Although it's stated here that the yearly cap is 150,000, just to note that this is a pre-approval amount, or rather, this is an amount that does not require pre-approval, right? If you are going to incur more than that, you can always go to ESG and apply for the approval from them to deduct more than 150,000. Just on talking about financial services, there are certain measures that the government has updated. So for retail bonds issue, there will be a double deduction for expenses to where the issuers are issuing to the retail investors. So your management fees and your issuers fees, right? You get double deduction up to a certain quantum. So it's really to encourage issuers to tap on funds from retail investors. Just very quickly on withholding tax exemptions, they have rationalized some of the terms of the various withholding tax exemptions, and because primarily the idea is these exemptions are very important for the proper functioning of the market, right? And for banks, finance companies, and other financial institutions, right, to continue in their daily business. Talk about sustainable growth, right? I mean, here we also look at fiscal sustainability, just like Irvin said just now, right? The basic fiscal position, has been under stress. Government has been spending, quite a bit on healthcare, and also the social, to preserve the social compact with the population, right? The social safety net for the less advantaged in our population. So all these payouts and jobs, you have your wealth, jobs credit, things like this to try and support, give a lift to the less advantaged. So it has been announced, obviously, in 2018 that GST will increase, right, somewhere between 2021 to 2025. We're in 2021 because of the pandemic. Obviously, not a good time to be doing that, and therefore, but the minister has paid very much, or rather has stated very clearly that it will have to rise, and it's sooner rather than later. I think over in PwC we have a bit of a different view. We think the rate hike will be 2023 rather than 2022. Just because there are attendant impact on businesses, right? Where you need to review your processes, you need to make sure your contracts, kind of protects you against any increase, right? And also for various businesses to consider if there could be GST relief schemes, right? And if the GST is going to go up from 7 to 9%, right, for non-registered GST businesses, right, the idea, the consideration has to be that you need to think whether this cost will become greater, for the 2% change, and whether then you need to think about your registration. I think in the center column, this is something that actually hits everyone. I'm sure all of us would have at one point or another bought, bought goods, any products over Amazon, your Taobao, your Lazada, right? So from 2023 onwards, all these, there's no more exemption of GST. The minute you buy something, click on the internet, buy that item, you have to pay GST. Okay. So what has not changed is really when you travel out of Singapore and then you come back and you get a GST exemption for $500 worth of goods. That's one way you can continue buying goods next time, right? But I'm not sure that's going to be a feasible way until travel allowed. In terms of for local businesses, when they are looking at the imported goods, right, because of the GST increase, because of the layering to the increase that's going to come, right? The idea is they need to think about how they can recover some of these input GST, and also there's the reverse charge situation where people, the reverse charge rule where they have to take into consideration. Just on the last point on GST, really there's just a change, a technical change in the basis of supply of online advertising. So the rule now will change to determine where the customers are based and where the direct beneficiary of the advertising services are to determine whether GST should be charged. I think, well, with all these changes, the government has not forgotten that there is still a need to continue building inclusive society. So they have extended the not-for-profit organization tax incentive. This is really for, foreign NPOs to come and set up operations in Singapore. Right, these you have NPOs like the WWF, the World Wildlife Fund, right, where they are expanding. They are just like a normal business organization. They're also expanding their operations to try and help more people, to further their causes. So this is a tax exemption when they come to set up their office in Singapore. A very popular tax relief is the 250% qualifying donations. So when you make a donation to IPC, you get a $2.50 tax deduction against your income. So this is now extended for another 2 years. We did hope that this will become permanent features, but I think the minister just want to kind of take it a bit careful for now, and they also just looking at there are many other ways to support the charities, right? Which is kind of the third point, coming to the extension of the BIPS scheme, right? This is a recognition that if you want to support a charity, it's not just giving of money, right? Sometimes if you provide your area of expertise to the, like for example, the account, for us, we can provide accounting services to these charities, right? The value of that giving might be worth more than actual cash, right? So this scheme is now, it was due to expire end of this year. It's now given another 2 years lease of life. I think, I've gone through all the tax changes in the budget. Just now going into a bit of crystal ball gazing, right? And this, just looking at the budget, government budget position, and we have obviously healthcare spending that's gone up to 11 billion, from 3 billion plus to now 11 billion over the last decade, And social spending, as I mentioned just now, also increasing. Not to mention investment in the future.
Sorry, Tay Lek, to interrupt, but we can't hear you. You've gone very, very soft.
Okay. Is this better?
That's much better. Thank you so much.
I must move nearer. I'm sorry about this. Investments into the future. About this is all the infrastructure projects that Singapore is going to have to continue its economic development. And of course, the challenge from climate change, right? As PM Lee has spoken about in the 2019 National Day rally, Singapore is taking kind of the long view towards trying to tackling the challenges that's brought about from climate change. So to fund all this, what do we have? We have the GST rate increase, right? As Irvin has said just now, we have some green taxes where, for those of us who, go into the budget speech, the petrol duty has gone up 15 cents. You see that after when you go and pump, immediately the prices has gone up 15 cents, right? So this is just one aspect of, how the government is trying to increase its sources of revenue, right, and at the same to fund its future needs. What I want to throw into this is really international tax developments, as you would have seen from the budget speech. The minister has, I quote there, right?
We've just lost you again. We can't hear you.
I'm sorry about this. Hi, is this better now?
Yes, Victor? That is much better. Thank you so much.
I don't know. Okay, as you can see from the budget speech, right, the minister, and I quote, he's mindful of international tax development and their downside risks. Okay, he's talking about this base erosion profit shifting 2.0 project. Right, some of the proposals will adversely affect income tax revenue, and he has stated that he will consider adjustment to corporate tax system, if the need arises. Okay, so just really, although just to kind of conclude here, right, although the budget does not seem to contain a lot of tax measures, I think the government is taking a bit of a caution stand and trying to then, look at to consider to bring into account these international developments, as and when the rules are more clear. As Irvin alluded to just now, the governments are spending a lot, and they will be looking at ways to fund that spending. So eventually, we believe that internationally the rules will change. There will be a consensus that companies, corporates, and perhaps individuals will have to pay higher taxes, and that will ripple on into Singapore's budget, in time to come. With that, I conclude my session. Thank you very much.
Thank you very much, Tay Lek, and thanks to all our speakers. If I could invite you to switch on your videos, and we'll have a quick Q&A. And ladies and gentlemen in the audience, I don't see any questions at the moment, so please, if you have any questions, take advantage of the fact that we've got plenty of expertise on the panel, and type in your questions and I'll be glad to pose them. But if I can just kick off and just pick up from where we left off, Tay Lek, on tax, because tax is the great worry for so many of us, both personal income tax and corporate tax. And I think you're absolutely right that eventually the only thing that can balance the books is that tax revenue's got to go up. And of course, in the Singapore case, it's going to be that mix between indirect and direct taxation. I mean, for me, there is a tremendous amount of angst over 2 percentage points hike in GST. And I think it needs to be seen with a sense of proportion, that if you look at the OECD countries, the most developed economies, their average GST equivalent tax is 19%. So, you know, even at 9%, it's not so bad. But my question for you is, do you think there's going to be a possibility for increasing a rate of tax for the highest earners in our society? Because that would make our tax regime even more progressive. What do you think?
Victor, is well, this is a recorded session, but I can tell you this is a sensitive question. You know, Singapore is out to attract, to set up or to grow the wealth management industry. We have many, you've seen in newspapers reports, billionaires are coming to set up in Singapore, right? So I believe income tax on the wealthiest, it will probably stay there. We think we are competitive. We've got definitely to watch out for Hong Kong. So, you know, given the structure of the individual tax rates, we are quite competitive with Hong Kong. You know, if Hong Kong drops, maybe then we'll drop. So at the end of the day, it is, you know, it is a bit of a monkey see, monkey do. But I mean, but you know, it's competitiveness there, right? Someone raises the prices, we also do the same. I think the government is very careful there. They want to grow the economic pie, and then, you know, if you grow, everybody makes profit, they collect more taxes, right? I mean, that's simply putting it.
Yes, I know. I mean, there is that debate about whether trickle-down economics actually works, but that's a different topic. And I suppose the other thing to bear in mind is that the top 20% of personal income taxpayers, really, they pay 56% or thereabouts of the taxes that go into the government's revenue. So yeah, competitiveness is one issue, but I get a feel that, or I get a sense that we're going to have to see some changes in taxation in the future, simply because of international pressure, as the Minister and as you alluded to in your comments. Yeah, thank you very much. Irvin, your comment about you know, the economic power moving east, and you illustrated that very dramatically and clearly by those slides, the blue and red. And I remember a couple of years ago being told that, you know, in the 1950s, if you mapped out the economic center of the world, it would be somewhere in the North Atlantic. And if you now map it out, it's somewhere in Western China, in Sichuan province or thereabouts. So it is extraordinary. And I think you and our experts from UBS also alluded to the fact that, you know, we're in the right region. And what I liked about this budget was it is even more of an enabling budget than before, with lots of schemes, lots of capital being made available, so that companies have no excuse but to take advantage of the region. Do you think our companies are ready to do it?
Well, interestingly, I did a webinar with one of the local trade association this morning, and there was a poll questions about, you know, to the audience, you know, regarding how keen they are in terms of expanding overseas, and very encouraging results from there. I think roughly at about 60% of our local companies are contemplating or in the works of it in terms of internationalization. I think there is very encouraging results. Our local companies are definitely looking into the region. So it is important that the government put out the necessary you know, support measures and basically serve as a facilitator to the whole process you know, of internationalization. Of course, given that the borders are still closed, internationalizations you know, remains very challenging. But I think one, you know, theme that has been repeated time and again in this budget is that, now is the time to build up your strength, your core competencies, so much so that, when we are out of this crisis, everyone will emerge stronger. So we must be the first out of the gate and to seize the opportunities, when it arises. And if you look back in history, I'm actually very confident because, every time Singapore economy dip into the recession, we are always able to recover even stronger. And the reason for that is this unique strength in Singapore, and that is economic agility. We are always able to adapt, adjust ourselves, and make ourselves basically in a position whereby we are able to capitalize the opportunities when we recover from the crisis.
Well, I mean, I certainly hope so. I tend to be less positive than many of you. I have real concerns that not enough businesses are going to take advantage of or go through the pain, because it is tough to build collaborations and so on, particularly across such a diverse region as ASEAN, notwithstanding the demographic dividend and the huge opportunity of what is already the world's 5th largest economy. But I love the positivism, and I know that was echoed by UBS as well, particularly with regards to Singapore, and that is very cheering. Given the fact that we are coming out of a dreadful year, and what do you think are the chances of companies being able to sustain themselves once they're weaned off the job support scheme, apart from the most affected sectors for which that scheme has been extended for very obvious reasons? You didn't really factor that into your commentary, but I'm just wondering how you feel about that. Valerie, would you like to take that one, or one of your colleagues?
Yes, I can take that question. Maybe Teck or Ching, if they see something on the ground differently, they can always add on. But I feel that the government's approach with regard to tapering of the job support scheme has been very gradual. I think typically generally with their policy initiatives, it is usually very calculated in a way. So I guess before they start tapering job support scheme, clearly on the ground, they've already seen companies adjusting to these challenges and also come out a lot stronger. So I believe that a lot of these companies would have already made the necessary adjustments, and we wouldn't see a fiscal cliff impact on the companies at a level with regard to further tapering of such fiscal approaches. So I'm not as concerned when this job support scheme or any other support measures are being put back, because it is not a very sudden approach by the government, because I think everyone is already anticipating it. And the stance for the government is always to help cushion this impact, right, with the companies. So they will most likely be able to do it in a more gradual manner for the corporates to help them ease through this period.
If I can share some of my observations here, I have to give credit to the Singapore companies. They have been very swift in reacting to this crisis. One example is how they have evolved their business models. For example, during the circuit breaker, taxi drivers were delivering my groceries. This was previously not announced, right? This was a new measure to help them adapt, to help them survive. And in addition, your cold chain management by sets, not only are they, well, now that they have no, not an insignificant amount of in-flight catering, they are now catering food services, non-aviation food services, and outsourcing their food production. So they have been very innovative to drive revenue growth. And on the cost side of the business, they have also, I give them credit, they have been able to cut costs quite nimbly. So I think Singapore Inc. will be able to survive and thrive once the pandemic blows over. I am optimistic.
No, and I really applaud the optimism. I think it's fantastic. you don't think that when the job support scheme tapers off, we'll see a sharp rise in unemployment? Yes, Irvin, you've got your hand raised.
Yeah, I want to weigh in on this, discussion about possible cliff effect if the fiscal support, particularly with the labor market, is being tapered off. Just to quote you a few numbers, I mean, for example, last year in the third quarter, that was actually one of the worst period in the labor market. But by the fourth quarter, we actually have a net employment gains for resident workers. So there were actually employment gains for resident workers. And also, if you look at the company cessation and company formations, we actually had a net company formation, and that was a record. If you look at the recent year's number in the second half of last year. So in other words, the number of companies that have been formed actually outnumber the number of companies that has ceased operations. So that basically underscore the fact that we have, in the second half of last year, we already saw recovery being filtered to the ground in terms of how companies operate, the viability of companies, and also it has been manifested in the labor market numbers. Also, I think we have to recognize the fact that fiscal resources is limited. It is important for the government to manage this very delicate balance. You do not want to keep zombie company alive by basically just throwing good money at them. All right. And many companies, in fact, many foreign companies also last year, they have returned their GSS that they have received from the government. So well done to those guys. So in other words, I don't see, I don't see the risk of a cliff effect from the tapering on in some of the budget measures.
More good news. So that's very heartening. Let's just take a couple of, yes, Valerie, you wanted to say something.
Yeah, so with regard to your comment on the unemployment, I think that there's a lot of opportunities that the government has created in some of the emerging sectors. What we've seen during the COVID instead is it actually enables people to instead find new jobs quite quickly in areas which is not within their previous field. So I think even with the job support scheme pulling back, and if say there's some initial increase in terms of the unemployed, I think it is quite heartening to see that a lot of people could quickly look for new roles elsewhere. I think in the government's budget, they've mentioned segments like technology, like healthcare. So I think that perhaps it's not as a big of a concern in terms of the spike in terms of unemployment numbers, because gradually that should see some digestion over the months or even in a couple of quarters. So we wouldn't be too concerned about that. Yeah.
Yes, and you're absolutely spot on in terms of, I mean, the budget focus was really on job creation. And while there has been some adverse commentary on, the large number of jobs in the public sector being created, nonetheless, there are so many schemes out there to help people change sectors and become or stay relevant, which I think is just phenomenal. And that is also very heartening. Let's just go to the Q&A box. There's a few questions. Evelyn has asked about property cooling measures. Well, I think when Ching talked about that, didn't you? That it may be the government is going to keep a very close eye to make sure that that bubble does not become too big and burst. And as you said, they have a very good track record of doing that.
Maybe to put some numbers in, to provide some context as well. The last time the government stepped in with property cooling measures, private home prices were rising by north of 3% per quarter. Currently, our run rate is roughly 2+% per quarter, and that was only in the last quarter. So I think if price increases were to accelerate, then we would be watchful of intervention. The other way to think about it is home price movements versus economic fundamentals. Our UBS forecast is for GDP to grow by 7% this year. So arguably, if prices were to increase by mid-single digits, that might be tolerated without further intervention.
Very insightful.
It's largely data dependent. That's our sense.
Yeah, which I think is exactly the right approach too. Alicia says, she's got a very long question, but let me see if I can summarize it. She's basically talking about the rise in the Vietnamese economy. And I imagine that goes back to Irvin's wonderful slide about how the Vietnamese economy will be larger than Singapore's by the end or almost before the end of this decade. So Alicia is saying, what does it all mean for Singaporeans, and what can Singapore PMETs and retail investors do to be prepared for the opportunities that would arise from this growth? And I've just got to the end of her question where she asked to be anonymous. I'm sorry about that, Alicia, but next time make your question short and sweet. Irvin, what do you think are the opportunities for Singapore and Singaporeans with this great rise in the Vietnamese economy?
Okay, Victor, I really, wish that I have another 30 minutes and I can share with you my set of slides regarding Vietnam. I've been covering Vietnam since 2007. That's the time when Vietnam joins the WTO. And last 2019, I wrote a paper about, Vietnam, and the title was The Rising Star. And to us, Vietnam is definitely an up and coming emerging regional markets that all companies and investors should pay close attention to. But a lot really depends on, which industry you're in and what are you interested in. Now, if you are PMETs, I think it is important perhaps to get yourself equipped with some of the basic understandings with regards to, the environment in Vietnam, and perhaps even talk to companies and consider posting, overseas postings to this country. I have many friends, Singaporeans, who are posted to Vietnam, and I can tell you that they have been telling me that it's boom town over there. Lots of opportunities. And for industries, a lot really depends on which industry you're, for companies, a lot really depends on which industry you're in. So I have been talking to many of our clients over the last 2 years regarding Vietnam. And if you're a manufacturing company, the place you need to go is actually Northern Vietnam, because, big global giants like Samsung, LGs, they have their manufacturing base in Northern Vietnam, outside the Hai Phong port, and that's where you have the biggest electronics. One of the biggest electronics, manufacturing facilities over there. But if you are in retail, the place to go is actually Southern Vietnam, because South Vietnam, especially around Ho Chi Minh, has been the commerce center of Vietnam for many years. And in terms of development, the Southern Vietnam definitely is much more advanced compared to the North. And that is where you see an emergent middle class coming up, an emerging consumerisms. People are getting richer and richer, property prices are shooting through the roof. And henceforth, if you are in the retail business, that's a place to go to.
Thank you. We have a question from Jack about GST on the imported lower value items. He says that he doesn't think this is going to have too much of an impact on or too much of a benefit for our local retailers. Do you agree, panel? How effective do you think it'll be?
I think the idea of this measure is not to help local retailers. Okay, it is to, well, the minister said, level the playing field. So it's to penalize the overseas, sellers, vendors, right? At the end of the day, if you buy something, maybe a phone, right? It's less than 400. It's not just the 7% can add up to be quite a bit, right? But you also look at maybe the ease of your which one can deliver faster, and maybe are there any other package deal that goes with it? So really, it's not. I don't think it's to help local. And the local, if you're small retailers, if your revenue is not more than $1 million, you actually don't charge GST on what you're selling, right?
Yeah, correct. And of course, it's a revenue issue as well. Yes, Irvin.
Yeah, I just want to weigh in a little from a different perspective. I do agree that basically the adjustments to the GST on imported low value goods is to level a playing field, not necessarily to benefit the locals, but basically to penalize, as what the other panelists has highlighted. But another perspective is this: look, e-commerce has been disrupting the retail scenes over the last few years, and more people are basically shopping online. Now, to the government, this represents a lost tax revenue. All right, so it is important that they try to recover this lost tax revenue, and this bring us back to our earlier discussions regarding fiscal sustainability. Now, because I think policymakers realize that e-commerce is going to become bigger and bigger, and that they are going to have, they're going to lose out more in terms of tax revenue from GST if they don't cover this particular gap. So I think it is important that they address this as soon as possible.
No, I agree. It is a revenue play, and dressed up as leveling the playing field. They need to do it because they're hemorrhaging revenue, and every country in the world is looking to do exactly the same thing for the same reasons. I regret that we've come to the end of our time together. We could go on and on and on because it was an extraordinary budget. And it really was about sustainability in its fullest meaning of the word, not just the green elements, but also social, fiscal, economic sustainability. And like you, our esteemed panel, it was full of optimism that yes, we need short-term measures to help us over this rough patch caused by the pandemic, but that does not mean we stop and we forget to plan and strategize for the future. So it was a very optimistic budget, and I think that's just terrific. So I want to thank all of you. Thank you, Irvin, Tay Lek, Valerie, Ching, and Teck Leng. Thank you so much for being with us, for sharing your expertise, for providing us with insights. And I want to thank the audience too for your participation, and wish you all a very, very good weekend. So thank you very much, and goodbye from all of us at SICC. Thank you.
Thank you for having us.
Bye.
Thank you.
Thank you.
Thank you.
Bye-bye.